Hi friends, where to invest 1 lakh rupees right now will depend on two key factors. Factor number one is what type of investor are you? So broadly, I categorize retail investors like you and me into four key categories. Number one is conservative, number two is balanced, number three is aggressive, and number four is ultra aggressive. And the second key factor is how long are you willing to hold this 1 lakh rupees? And I broadly categorize into three main categories. Number one is less than 1 year, number two is between 1 to 3 years, and number three is more than 3 years. So if you look at this grid, we see that there are 12 different cases, and depending on which bucket you right now fall, your 1 lakh rupees needs to be allocated based on that. And in this video, I'm going to walk you through these cases based on data and facts, not based on any random allocation. And before I start case one, I also want to say that these four types of investors, one person doesn't need to be only falling into one category only. Some of the portfolio might be falling into conservative bucket. Some of your portfolio might be falling into ultra aggressive bucket. So it really depends on your portfolio and where you want to take the maximum bets. With that, let me now walk you through case number one, which is if you are, for example, a conservative type of investor, and if you want to hold this 1 lakh rupee for more than 3 years of horizon. Let me now first clarify what do I mean by a conservative investor. So conservative investors are those investors who basically wants to take zero risk with their capital, meaning they do not want even a single rupee to be lost from this 1 lakh rupee. What is really important for them is that they want to protect their capital, forget about returns for a minute. And a good example might be that you want to right now invest 1 lakh rupees for your child's education, and you do not want to take any risk with this money. You want to make sure that this 1 lakh rupee as a minimum remains 1 lakh rupee, and it should also give you reasonable returns. What I mean by reasonable returns is that, let us say you want to generate somewhere between 7 to 12% of returns every year, and at the same time what you want to do is you want to make sure that you do not want to lose even a single rupee out of this 1 lakh rupee, but you want to generate returns between 7 to 12%. So in such a case, which is case number one, where should you actually put this 1 lakh rupee right now? My view in this case will be that you can consider investing close to 30% money in fixed deposit, 40% in Nifty 50 index mutual fund, and remaining 30% in blue chip stocks. Now, this is not a random selection that I've just figured out. I am now going to present to you data and facts, and more importantly, I'm going to run you through three different scenarios. What is the scenario number one, that what are the best case returns possible for you? Number two is what is the worst case scenario possible for you? What is the worst returns that you're likely to generate? And number three is the average returns that you're likely to generate, which is more reasonable estimates. And I'm now going to present you data so that you can understand this concept from data perspective, not merely from my opinion perspective. Before I move further, let me introduce mStock, which is an investing platform by Mirai Assets. And good news is that you can now get free demat account from mStock and enjoy zero brokerage on deliveries, mutual funds and IPOs that used to cost 149 rupees earlier. And if you are an expert trader, then mStock right now is offering zero brokerage across all their products, including FNO, currencies, mutual funds, IPOs, etc. at a one-time payment for rupees 999 only. Opening a demat account with mStock is extremely simple. All you need to do is enter your mobile number. You will get an OTP. Verify your mobile number. Step number two is verify your email ID. Number three is enter your PAN card details and verify it as well. Then you can choose the plan that suits you the most. Next step is to upload your selfie and verify your signatures. You can then add your bank account details, and last step is doing your KYC registration. There will also be an option for you to activate FNO segment. For this, you will have to add your Aadhaar card details, and that's it. You're done. So what you see on my screen is a simple calculations of holding period 3 to 10 years and fixed deposit, Nifty 50 index and blue chip stocks getting the allocation as 30%, 40% and 30%. Now, if you look at the returns, what we see is that fixed deposit generally is likely to give you 7% return on an average. So in 1 year, you are going to get close to 2100 rupees on this 30,000 rupees. The second point is Nifty 50 index. Now, best case example, Nifty 50 can give you 28% annual returns. And for this, let me now present to you data. So we are going to look at rolling returns. So you see here on my screen Nifty 50, and I have gone back to 20 years of data. and I have looked at 5 years of rolling return. Now I'm assuming that between 3 to 10 years, I'm saying that let us say that you are going to hold this 1 lakh rupee for 5 years, right? Now if you look at the best possible returns, the maximum return in this period from a rolling return perspective that Nifty has ever given is 28%. So I am going to use this 28% as a calculation here. So that is what you see here. So annually on this 40,000 rupees, you are going to generate 11,000 rupees roughly every year. Then comes the blue chip stock. So I'm saying 30% allocation in blue chip stock. So let us have a look at last 5 years CAGR that blue chip stock has generated. So let us go ahead and have a look here. So what I've done is I've taken top 50 stocks from the stock universe, and what you see clearly is that 5-year CAGR, if I look at, you will see that except Adani that gave 75% returns, an exceptional situation. All of us know the Adani stocks soared like anything, and there is a lot going on with that Adani stocks. That's a different story altogether. But if you look at, you will see likes of Apollo Hospitals, Titan Company. By the way, these are not any recommendations. I'm just giving you some gist of data and my approach to this analysis. You will see that close to 30-35% of returns, few of the stocks have managed to generate. So let us assume that you are a good stock picker and you know how to pick good blue chip stocks. Then the best chances are that you might be able to generate returns of 35% per year for the 5 years period. That will give you 10,000 rupees on this 30,000 annually. So the best case scenario is that if I do this allocation, then you will see that on this 1 lakh rupee, you are going to generate 23,000 rupees every year with this allocation of fixed deposit, Nifty 50 and blue chip stocks, and it will give you close to 24% returns. But remember, this is only best case scenario. I am now going to run you through worst case scenario as well, so that you understand the second side of the spectrum. Also, I will tell you that reasonable returns or the average returns that you are likely to generate. Let me now walk you through the worst case scenario. So what you see on my screen is, in the worst case scenario, what is likely to happen is that your FD is still going to give you 7% returns. But from a Nifty 50 index perspective, if I go back and have a look at the same data here, you will see that the minimum return that Nifty 50 has given on a 5-year rolling basis period between 2003 and 2023, you will see that it is minus 1%. If I go and plug minus 1% here for Nifty 50 index, that we are going to lose 400 rupees here. But now if you look at the blue chip stocks, if we go back and have a look at the 5-year CAGR, let me go ahead and look at the minimum returns we have got. So you will see that in the last 5 years perspective, some of the stocks have given close to minus 4% returns in a negative way. So I am going to use minus 4% because remember, this is the worst case scenario and it can happen with anybody, even if you are a good stock picker. So let us plug this number and you will see that with this allocation, you are still going to be 1% better. Even if we take the worst case scenario, you are going to make 1% on an annual basis. So this is the other end of the spectrum, where let us say that you make a mess of investing blue chip stocks, or Nifty 50 does not perform, then still you are not going to lose your capital. By the way, how to pick blue chip stocks and which are the blue chip stocks, I have created a few videos on my channel. You can use them as a guidance only. Please do not go and just invest in those stocks, because at the time of creation of those videos, the valuation of those companies might be very different from what you see today. Use those videos as a guiding principle and do your own research to find out good blue chip stocks. You can also consider subscribing to my channel, because more often than not, I create a lot of videos around stocks that will help you understand how to go about picking the right stocks. Let me now move to scenario number 3, which is if you get average returns, what is going to happen? So let us look at the allocation again. So FD is still going to give you 7% returns, but from a Nifty 50 index perspective, this time if you look at the data, we will see that the average returns Nifty 50 has given for a 5-year holding period from 2003 onwards is 12.40%. By the way, what you also see here is the median 12.73. Not many people understand the difference between average returns and median returns. So I would like you to let me know in the comments if you understand the difference between what is average versus median. So here I have assumed 12.50% as a average return from a Nifty 50 perspective. When it comes to blue chip stocks, the way I have approached this from an average return perspective is that if I look at the 50 stocks here, you will see that out of these 50 stocks, if you look at 25 stocks, so let us go ahead and have a look here, Cipla, which is 25 stocks. So 25% stocks have given close to 14% or 15% returns, while 25 of these stocks have given less than 15%. So my approach here is I am considering 15% return from that perspective. So I have plugged in 15% number here, and you will see that with this logic, average returns that we are going to generate is 12%. and that is going to be the reasonable returns that you can expect from this allocation being a conservative investor. So let me now quickly summarize case number 1, which is you're a conservative investor and you are investing for more than 3 years of time horizon. Then your best case return is annual returns of 24%. Worst case return is 1% return, and average case return is 12% return, depending on how much of time and effort you put in selecting, for example, blue chip stocks, and how does Nifty performs more importantly. Let us move to case number 2, which is you are a conservative type of investor and you only want to invest your money for a time horizon of between 1 to 3 years. An example might be that you want to go for a holiday in the next 1 to 3 years and you want to invest 1 lakh rupees for your holidays. You do not want to lose even a single rupee out of this 1 lakh rupee because this holiday is important for you. For this, the allocation we are going to use is slightly different because what we want to make sure is that we do not lose our money in the worst case situations. So what you see on my screen is here I am proposing a fixed deposit of 70,000 rupees out of 1 lakh rupees, 15,000 rupees in a Nifty 50 index and remaining 15,000 rupees in blue chip stocks. Let us now understand the rationale behind it. Let me now present to you the best case scenario. In the best case scenario, your fixed deposit will still give you 7% returns. But from a Nifty 50 index perspective, if we look at the data, we will see that if we look at the 2 years rolling period, so I assume that you're going to hold it for, let us say 2 years, which is between 1 to 3 years. Then we look at the data, we see the maximum return, the best case return that Nifty 50 has given is 64% annual return. So let us go ahead and use that number here, 64%. And from blue chips perspective, if you look at the last 1 year data, we will see that few of the stocks have managed to give close to 40% returns here. So the best case scenario is, let us say you picked up good stocks that are generating 40% annual returns, then I will consider that 40% number here, and that will give you average return of 21% annually. And remember, this is the best case scenario. Let me now walk you through the worst case scenario, what could happen here. So if you move to worst case scenario, the FD return still remains 7%. But from a Nifty 50 perspective, if you go back and have a look at the number here, you will see that the minimum is minus 17%. So it is possible that Nifty might go down by minus 17% annually. So let us use that number here and we get minus 17% here. From a blue chip stocks perspective, if you look at the data, so if I just sort it by negative results, what we see here is that if I remove Adani as an exception, and if you look at the next few stocks, we are able to see that some of the stocks have given close to minus 15% returns. So I'm going to use minus 15% here as a number, and this allocation now still makes sure that gives you 0% returns. You're still not losing your money with this allocation because simply you have done higher allocation on your fixed deposit. So you're less likely to lose your money. But again, please understand this is only worst case scenario and best case scenarios that I've explained. Let me now walk you through the average case scenario. So from an average case perspective, FD still 7%, Nifty 50. If you look at the average returns of Nifty 50, close to 16%. I've used that number here. And from blue chip perspective, if we look at the data, let us go to stock number 25. You will see that some of these stocks have managed to give close to 14%, 15% returns here on an average. So I am going to use 14% return here. That means that the average case, which is more reasonable case, you are likely to generate 9% annual returns with this allocation. But in the worst case scenario, you will still not lose your money. So this is your case number 2, which is holding period of 1 to 3 years and you're still being a conservative investor. So far, if you're finding this video useful, a humble request to hit the like button and also let me know in the comments a simple thank you message. It will encourage me to come up with such videos more often. Let us now move to case number 3, which is that you're a conservative type of investor and you want to invest this 1 lakh rupee only for short term, which is less than 1 years of time horizon. So in that case, the allocation I would suggest is that you go for a fixed deposit of 80%, Nifty 50 index 10,000 rupees or 10%, blue chip stocks only 10%, 10,000 rupees. Let us now consider the best case scenario from a returns perspective. So if we look at FD perspective, 7% returns. From a Nifty 50 index perspective now, if I show you the data, we will see that the maximum return, if I consider the monthly rolling returns, then you will see that you are going to get close to 30% maximum returns that is possible if you look at the past data. So I'm going to use 30% here. So 30% data from a Nifty 50 perspective. If we now look at the blue chip stocks, so let us go ahead and have a look at blue chip stocks. I've considered last 6 months returns and you will see that few of the stocks have managed to give us returns in the 40% if you manage to pick up the right stocks here. So let us use the best case scenario of 40% returns here, and that gives you 13% of best case returns in cases of this allocation. Let us now consider the worst case scenario. So from a worst case scenario perspective, FD remains 7%. Nifty 50 index, if you look at the data, we will see that it can go down to minus 37% if your holding period is less than 1 year. So with that, let us go ahead and have a look at that and put this minus 37% number here. From a blue chip stocks perspective, if we look at the negative returns, the lowest returns, you will see that UPL, for example, has given close to minus 10% returns. So I'm going to use minus 10% as a number here, and that gives you average returns of only 1%, because remember, in this case what we have done is majority 80% of our allocation is in fixed deposit, because remember, Nifty 50 and blue chip stocks are not going to give you lot of returns in a very short period of less than 1 year. Hence we need to make sure we put more money towards the fixed deposit in this example, because we are a conservative type of investor and our first rule is that we do not want to lose our money. Let us now look at the average returns or reasonable returns that you could expect here. So from a FD perspective, 7% return. From a Nifty 50 perspective, if I show you, the average return is going to be only 1% if we look at investment horizon of less than 1 year. So let us go ahead and use 1% here. So from blue chip stocks perspective, if you look at the data here and let us go down to stock number 25, and we will see that more than 25 stocks has given close to 22% return. So let us go ahead and put that number. Actually, I made a mistake here, 3%. It is 22%. So let us change that number here. And with that, we get average return of close to 8% return. Now, the only limitation I see in this model is that if I look at the data here, I have considered 6 months return here, and please understand right now we are in bull run. So from a blue chip stocks perspective, the results might be very different if we are in a bearish environment. But this framework still gives us better approach when it comes to how to allocate funds. So with this, I hope you're clear with case 1, case 2 and case 3. Now, in order for me to create case 4, 5, 6 and so on, let me know in the comments part 2 of this video. I'll be happy to shoot part 2 of this video, because this video is anyways getting longer now and I want to take a break now and create part 2 of this video, but it all depends on your response. So let me know in the comments if you would like me to shoot part 2 of this video. Secondly, you can also consider joining my YouTube member community if you want to learn how to do in-depth analysis on stocks and mutual funds and other assets, because I put out a lot of exclusive content only for my YouTube member community. With this, I hope to see you in my next video. Until then, keep rocking.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.